we will continue our discussion on valuation. So far, what we have discussed is why valuation is so important. And we observed that in the past, whenever valuation fundamentals were not followed, there was a financial crisis which really took us back to where the fundamentals should be. And we also introduced you 3 basic elements of valuation. Throughout this course, we'll continue to build on these 3 elements. Let me just write it down. Well, the first one we introduced was return. And the way we look into return or profitability is through return on invested capital. We have dedicated a complete section on return on invested capital, which I'll take you through after a few modules. And the second we introduced was the cost of capital. That is, this cost of capital is also known as weighted average cost of capital. We'll deep dive into this topic and we'll discuss in terms of how to really arrive at weighted average cost of capital. And then we also discussed about the growth element, which is the third most important element in valuation. Again, we have dedicated a complete section on growth, how to value that. But before we get into all these discussions, let me go back to some of the fundamentals with respect to what are the models available. What all valuation models do we have in order to value a company? Well, there are various methods for valuing a company. Because with each stock or each industry and its uniqueness, your valuation approach would vary. Where data is available in detail, probably what you'll do is even get into a detailed elevation model in the form of a discounted cash flow or dividend discount model, where you're comparing the performance of the company with the rest of the companies. Then you will actually look into the relative valuation model. The choice of valuation method would primarily depend upon which stock you're valuing and which industry you are focusing on. As we discussed, there are 2 methods to do this. One is the absolute valuation method. Under absolute valuation method, what you're looking at is a true value of an investment. For example, if you're looking at Microsoft stock, what is the intrinsic value of the true value of that stock? So let me just explain you this. I just open up this page on Yahoo Finance to look into what is the stock price of Microsoft. It is old price. It's 28.09. Well, in this, what we see here is the price is 28.09. However, what analysts would do is they will look into the past performance of this company, and then they will apply assumption to basically understand what are the future expectations. So when I refer to this intrinsic value concept, this intrinsic value is primarily that true value which based on your calculation. Think that the price of Microsoft should not be 28, it should basically increase to 35, or it could be in future it's going to decline to 25. So it depends on your calculation, and obviously there are a lot of assumptions which go into this calculation. In terms of what should be the true value of a particular stock, for example, in this case, we looked into the Microsoft, and it gives me this price. So what you'll do is you'll basically estimate the future of this stock. After 2 months or 3 months, what should be the true value of Microsoft stock in the future, whether you should buy it or whether you should sell it. And there are various methods you can do that. As I mentioned, you look into the history, that is basically looking into the fundamentals. When I said fundamentals, we introduced 3 basic fundamentals, return, cost of capital, growth. And you need to basically understand in detail, what is driving the value of a particular company. So this is basically starting that one company. You just study Microsoft. There is no other competitor of Microsoft you're studying or anything of that sort. You're basically focusing your effort on Microsoft. Evaluation in order to understand what is the true value of Microsoft shares, and you do it through. There are various methods to do this. One of the major ways of doing this is through dividend discount model or dividend discount flow. We'll get into more detail on these topics later on, but for now, these are primarily 2 methods which we use under absolute valuation models. We'll discuss it in detail later on. Moving on to the second way of valuing a company as a relative valuation model. So what do we mean by relative valuation model? So in this, what we are doing is we are basically comparing valuation of a company relative to its competitors. Let's say we are looking into Microsoft. So when you're doing valuation through relative with respect to Microsoft, let's say which all other companies would be its competitors. Let's say Oracle would be one of the competitors, Google would be a competitor, Apple would be a competitor. And, these are mainly the competitors of Microsoft. Even Sun Microsystem would be a competitor, and so on. Based on the similar industry risk and similar industry, you'll basically arrive at what are the competitors, and you'll basically compare their ratios. For example, you might have heard of one popular ratio, which is price-to-earning ratio. Let's say the price-to-earning ratio of Microsoft is lower than the average of the industry. Let's say we arrive at industry by taking 4 or 5 competitors with Microsoft. In that case, what we basically say is, Microsoft is undervalued. You should be buying Microsoft. The other way would be in case the price-to-earning multiple of Microsoft is higher than the comparable, the average, or median comparable, then we'll say it's overvalued and you should be selling Microsoft stock. But this all will be indicative of what the future will be. So whatever we are trying to do is about the future. It has nothing to do with the past, although we do look into the past to just get an estimate of what will be the future. But we are not basically replicating history into the future of that. Maybe Microsoft has performed brilliantly in the past. We cannot really assume that it will continue to perform like that forever. You know, a good company doesn't mean good stock. So you need to really distinguish between these two concepts. Microsoft can be a very good company culturally or social impact it has and so on, but that might not be the best stock to purchase.